they're both risks and opportunities now in private credit. As we saw rates rise, rates overwhelmed the return profile of private credit. Now as rates are declining and spread is more of where you're getting the income, that's where credit selection really matters. I think with private credit in particular, we are seeing a difference in vintage in terms of performance. It's a several factor conversation here. First is we are seeing weakness in the software sector. We're seeing some concerns around marks, and we're seeing concerns around the liquidity that's been promised against an asset class that is by its nature illiquid. Now, in terms of vintage, it impacts all three of those. There's a pre-2022 vintage and there's post-2022 vintage. The pre-2022 rates were ultra low. Software was not a concern. It was considered a darling sector in private credit and in private equity for that matter. And 2022, November of 2022 in particular, is when ChatGPT was released. And prior to ChatGPT, private equity firms and private credit managers weren't really envisioning how AI could disrupt legacy software as a service companies. So as you look at BDCs, the publicly traded BDCs that have been in operation 10, 15 years, and then the semi-liquid BDCs that have really grown in earnest since 2022, you're seeing a divergence in performance there. Now, investors are kind of brushing it all with the same brush, and you're seeing publicly traded BDCs trade at steep discounts, as they maybe should, given some of that pre-2022 vintage and the software exposure. But that's flowing over into the private BDCs, where you're seeing meaningful outflows, especially out of tech-oriented or tech-heavy BDCs, because of that concern.
So first, is this a shakeout? And two, if it is, how much longer does it last? What is the logical conclusion to all of this?
It's really hard to predict. All you could do is prepare. And I can tell you, at Oaktree, we have been preparing for this type of event in many ways. First of all, direct lending for us is not a huge part of our assets.
Wait, so to be clear, you thought that this time might come, that there could be some nerves around some of the bad vintages?
We always put our client interests first. So what that means in the context of this type of product where you offer liquidity, it means you have to conduct your affairs in a very prudent or conservative way. Having liquid assets that you could generate cash, not excessively levering the portfolio, being able to draw upon multiple levers for you to return that capital to investors to the extent they call upon it. We couldn't predict what happened now, but we did prepare, and this has prepared us to be on the front foot, actually, and take advantage of some of the volatility we're seeing. At Oaktree and at Brookfield, we have a long history of investing in through cycles. In the case of Brookfield, as an owner-operator and with deep expertise in certain types of assets, and in the case of Oaktree, as one of the largest distressed debt managers in the world, and with Howard Marks's highly principled way of investing and not growing for growth's sake when we absolutely could have, has positioned us well now to take advantage of some of this volatility.
Let's step back and talk about Oaktree, because I'm just a private credit tourist, but I've visited Oaktree a lot and Blue Owl of late. What separates Oaktree from these newer BDCs?
So private credit is a very broad term.
Yeah.
Direct lending is the largest and most frequent part of it. We view private credit at Oaktree as not, hived off of the rest of the credit platform or the rest of the credit opportunity set. We view it as part and parcel to the offerings in liquid credit and part and parcel to the offerings in distressed debt. Now, what do I mean by that? As we invest in private credit vehicles, we compare the relative value against other areas of credit. And when we do see dislocation in liquid credit, and not yet in private credit, we slow down what we do in private credit because we think it'll bleed over. When we see opportunities in distressed debt, where we see certain industries or certain markets or certain regions dislocating, we then tone down what we do in liquid credit or in performing private credit, because that is an insight into what shoe may drop next. Now, flip side, so that's managing risks. There's also taking advantage of opportunities. When we do see large dislocated opportunities for capital solutions, we want to take advantage of those and provide those types of solutions in our private and public credit vehicles.
By the way, can you do that now? I mean, when we have massive requests for redemptions and BDCs selling assets in order to fund that, so far it doesn't look like a fire sale. They're putting out decent numbers close to par, but under the surface, are you seeing real discounts?
So not yet. The discounts, I think, for now or the sales for now are quite orderly. And look, in terms of the semi-liquid BDCs in particular, it's pretty clearly described as being an up to 5% liquidity offering or repurchase offer for clients. Unfortunately, some of the redemption requests have been meaningfully in excess of 5%. And I think that there could have been some differences of opinion or differences in style in terms of laying out those risks around the liquidity. But I don't think that those BDCs on their own are going to generate significant amounts of selling pressure. Now, I think what I do think can generate selling pressure or challenges are the leverage providers to those BDCs and to those direct lending vehicles. As they get a little bit nervous about true credit losses in software or otherwise, they may cut back on their leverage profile or their leverage tolerance, and that could result in sales or a need for capital solutions to come in.
So is that, and forgive my ignorance here, is that kind of like JP Morgan coming out and saying, oh, we're going to mark the private credit funds differently because of their software exposure?
Correct.
So what does that look like if you get some of the banks pulling off on their willingness to lend?
So it will mean capital needs to come in to either delever the banks or those managers that have an upside-down condition and essentially a margin call. They're going to need some sort of kick-save solution in the form of equity coming into those vehicles. The third option is to fire sale.
Does it look like we're somewhere close to that, or are we on a path to that happening?
I think this is a correction. I don't think this is a systemic kind of rejection of the private credit asset class. The question becomes, how deep is that correction or recalibration? I think we're in the beginning of it, but I don't think it's going to result in meaningful amounts of distress. So there will be opportunities.
I mean, that's what I want to ask about as well, because everyone we talk to about private credit says, look, it's a $1.8 trillion market. The BDCs, semi-liquid BDCs are a smaller subset of that. Their software loans are a smaller subset of that. Those that can be eaten by AI are a smaller subset of that. So it seems like not threatening at all, but you must think about this all the time. Is there any way that this bleeds into a bigger problem for markets more broadly, or a bigger problem for the economy more broadly?
I think it's a question of confidence, whether the combination of the factors that you just presented in software combined with fraud, the cockroaches headline, some questionability about marks. We have seen drastic reductions in marks that cause people to say, well, wait a second, how did that happen all of a sudden? One quarter something's marked at par, the next quarter it's at zero. It's a question of confidence all the way around. I think with respect to software in particular, though, the problem is probably bigger than what you described. And there's a couple reasons why. One is there are software companies that are tagged as something other than software. For example, business services or government services. So you do need to, within the scope of AI risk, you do need to kind of add plus some other industries. That's one. The second is when you lever some of these vehicles, as much as 1-to-1 or even more than 1-to-1, and if software is 20 or 30% of a portfolio, which is on the low end actually, some vehicles have 40% software in them. If 5 to 10% of that portfolio has true AI risk, and when a company is at risk of AI, there could be a binary outcome with that business. It could just go out of business and just be completely displaced. The losses can be, on an unlevered basis, can be quite severe. Then you lever it 1-to-1, and it results in a 10%, 15% hit to your equity, possibly.
And I know on one of the earnings for one of your funds, you talked about this and talked about a pretty rapid degradation of performance, quite problematic recoveries. So for funds that have this, have we fully understood? Because a lot of funds wrote down their loans in February saying, look, we've reflected this. Is it not fully reflected in that, then yet just how bad things could get?
I think nobody knows how bad it can get at this point. I think if I asked you a question 12 months ago about AI, about agentic AI, could it displace a software as a service legacy provider, you would say, I can't even envision what that means. Today, I think we can envision that agentic AI is quite powerful, and that any software program that you use day to day, you could go into it, bring an AI agent with you and say, can you just recreate this for me? And it's not too far out of the realm of reason to think that that could actually happen. The progression of AI is very hard hard to predict, and therefore I think it's too early to say that the marks are, that we've seen the lowest of the marks.
By the way, does this mean that you would completely avoid software companies from here on out, just because that's a really big left tail that is so hard to understand just how big it even is?
Yeah, I think the hurdle is very, very high. It needs to be a winner in terms of in a post-AI world. It needs to own that part of the market. It needs to be an AI-driven company. We're not going to completely avoid them, but I could tell you over the last several years, we have avoided all of these recurring revenue loans, the PIK interest loans, the paid-in-kind, non-cash pay. And it was really because we just didn't think we were getting appropriately compensated to take on non-cash pay interest. Now, with the benefit of hindsight, it was a good move, because as those claims rose with the non-cash pay interest, what we've seen in the last 12 or 18 months is a drastic decline in the valuation multiples of some of these legacy software companies. So your claim has grown, your V in that value has come down, so your loan to value is meaningfully higher today in those businesses than they were when the deals were done.
You know, when I look at the circumstances that led to the vintages that we hear now are not going to be great, one of them is just a flood of liquidity, right? So much cash chasing limited returns, and it feels like that could still be the case today. Do you see that?
We're seeing a recalibration of spreads.
Do you have clients coming to you saying, like, put all this money to work, please?
We are seeing institutional clients still allocating to the asset class, yes. We are seeing a meaningful slowdown in retail. Now, I think it's more balanced, and the output of that balance is that we are seeing some recalibration of the spreads. So new deals that we are talking about outside of software are going a little bit wider, not tremendously wider, not to the level of indicating stress, but not to the same level of too much capital chasing too few deals.
Well, I also think one of the things that you're probably hinting at, Matt, too, is that you have this other source of capital come in, and that is retail. And the nature of the funds of retail ones is you have to put that money to work right away. And yes, now it's slowing, but I wonder if before that point, if you also saw some recklessness come in that maybe kind of rhymes with what you saw in 21 and 22.
Yeah, I mean, anytime that in a short period you do get meaningful inflows and cash drag creates a big problem for returns, then you do see excessive risk-taking in any asset class. That's true in equities, that's true in credit, that's true in private credit. And we have seen that definitely over the last 5 or 6 years, and it was compounded by the fact that every year for the 5 or 6 years, there has been some sort of curveball that has created a condition where M&A or LBO deal volumes were lower than expected. So we had COVID. Then we had a good year after COVID in terms of LBOs in 2021. But in 2022, this thing called inflation was not temporary. It was permanent all of a sudden, and rates drastically rose, valuation multiples fell, private equity grinded to a halt. Then we had, obviously, we've had the war in Ukraine. When Trump was elected, people thought the deals would come back, and then immediately we have Liberation Day. Now we have a war in Iran. So there have been reasons why private equity sponsors have taken a little bit of a pause on deal flow. But at the same time, because rates rose, there was a tremendous amount of inflow into credit,
right,
and in private credit in particular. And when you do see it in these retail vehicles where you must deploy, if that is the entirety of your investment management firm's profit number, then you got to put the money to work. So some excessive risk-taking happened.
Armen, you say you've seen spreads widen even outside of software, but not to levels that would signal stress. And I'm wondering if they don't widen to stress levels after massive tariffs and chaotic trade policy, after a war in Iran, the closure of the Straits of Hormuz, the doubling of oil, prices, BDCs getting 41% redemption requests. Like, what pushes spreads to levels that signify stress?
It's a great question. You really do need to see a continuation of the exposure of mismatched assets and liabilities. I mean, that's a very general comment, but for now at least, and since COVID, there has been a tremendous amount of liquidity in the markets. And what that has resulted in is when the markets have fallen, equity or credit, there's been a buy the dip mentality, and that's worked. Generally. Now we'll see if it's going to work in this period of volatility we're seeing at this point. But you have to see a crisis of confidence for that volatility to go to the sidelines and stay on the sidelines.
By the way, are you worried about any of the things Matt was talking about causing that crisis of confidence?
The breakup of NATO?
Well, there's a lot that could trigger it. Now, in terms of oil in particular, if oil stays meaningfully above $100 for an extended period of time, there are certainly people in the markets that do believe a recession can happen. And there are parts of the world right now that are experiencing recessionary types of impacts. For example, in broader Asia, where a lot of the oil that comes out of the Straits of Hormuz, especially highly refined products, or the oil that makes highly refined products, are causing a shutdown in some businesses in Asia. Now that could cascade and cause issues that create inflation in the U.S. or in other parts of the world. You can see some recession. It's hard to predict how deep it will be or when it will be or if it will be. But a prolonged war with meaningfully escalated oil prices and the tail that oil, even if the war ends tomorrow, there is going to be a tail where refined products and oil remains elevated because production has slowed in the region. You can't just turn off and turn on oil wells just for safety reasons. So there's going to be a lag effect even when the war ends. So I think that there is a growing tension or a growing consideration in the markets of a potential recession. And if this war continues, I think that could be something that we see later this year.
Armen, this has been so smart. I wish we could do this all day. Unfortunately, we're out of time, and you've already been very generous with your time. Thank you so much for stopping by. That's Armen Panossian, Oaktree Capital Management, co-CEO and head of performing credit.